to talk about, and I'm going to show you how to read and actually understand a balance sheet. Coming up. Hey there. If this is your first time here, my name is Steven Spicer, and it's my goal to help you invest smarter. And if you're trying to invest in individual stocks or buy a company outright or evaluate the health of your current or future business, well, to do so intelligently, you're going to need to understand the balance sheet. All right, here's how it's going to go down. We'll briefly explore exactly what is a balance sheet, and then I'll talk about the balance sheet equation, how it's telling us what it's supposed to tell us. We'll explore in detail the assets, liabilities, and equity. And then we'll run through the three most valuable metrics you can derive from a balance sheet, what they are, how they're calculated, and why they're important, what they can tell you. Finally, we'll wrap up with a quick example. I'll pull up a real live balance sheet here on my computer. In future videos, if you're interested, if you think it'd help, we can explore the balance sheets of some other of the most widely held companies in the world. If that's something that you'd like, then definitely hit the like button. That's really important to making this all work. And then let me know down in the comments what companies you'd be interested in running through. If you're interested in obtaining real value like this from a practicing professional, don't forget to hit that subscribe button and the little notification bell. All right, let's dive in. Our first stop, what is the balance sheet? The balance sheet is one of the three most common financial statements produced by public and private companies alike. It's designed to give you a snapshot view of the value of a company. It does this by listing out and valuing and totaling all of the assets and liabilities as of a specific point in time, a specific date. That date is known as the reporting date. This entire statement is effectively one big calculation, helping you to assess the company in question's so-called book value. When public companies report their earnings every quarter, they also prepare and distribute updated financial statements. That's why when you look at this data on Yahoo Finance, MarketWatch, or one of my favorites, Uncle Stock, you'll be able to break this data down on an annual or quarterly basis. Now, to find a company's official updated balance sheet, as these sites will occasionally transcribe the data incorrectly, you can reference their most recent 10K or 10Q. You can find those officially at the SEC's EDGAR site. I'll link out to that in the description and everything in the description. But I always find it easier to pull them straight from the site called Seeking Alpha. Again, check the description for that. I would definitely look at their official 10K or 10Q just to verify the numbers you've been looking at before actually purchasing a stock. But while you're doing your initial research, these online sites can make it much quicker to quickly evaluate a company and rule them out. The purpose of a balance sheet for an executive or board member is to help them know whether their company is succeeding or failing in various different areas. They can pinpoint what's working and what's not and adjust policy accordingly. Alternatively, you can use this information to determine whether you'd like to invest in a particular company. You can use the information on a balance sheet to observe how one company is performing compared to others in its same industry, for example. More on some of the metrics that would be helpful for you in that process here in a bit. It's for the latter use, you trying to figure out if a company is worth your investment, that will gear most of our focus here on this channel, as I'm assuming that's how most watching will be using this information. Now, a quick note, it's important to keep in mind that by its very nature, a balance sheet is always outdated because it reflects the information from a specific point in time. By the time you're looking at it, the reality is pretty much always different, even if slightly, sometimes potentially significantly. All right, now the balance sheet will almost always be divided up into the formula assets equals liabilities plus owner's equity. Prepared properly, this equation will always balance. Assets must always equal liabilities plus owner's equity. Or put another way that will likely come off as more logical to most, especially after reviewing the explanations below, the assets minus the liabilities will equal the owner's equity. So let's talk about assets real quick. An asset is anything with economic value owned by an entity. On a balance sheet, you'll generally find assets split into two major categories, current and non-current, as distinguished by how easily and quickly they can be converted into usable cash. For assets to be considered current, that timeline needs to be less than 1 year. For example, as an individual, your current assets might include the money in your checking and or savings accounts, the bike that you just listed on eBay because you expect to have exchanged it for cash within the year, the stocks in your brokerage account, and the money that your colleague owes you for picking up his lunch tab last week. Pay up, Brody. For a business, in their actual balance sheet, we'll see categories like cash, cash equivalents, which tend to be safe assets that can quickly and easily be converted into cash, like U.S. Treasuries, for example. Inventory, which includes the company's raw materials, partially completed materials, and finished goods. Marketable securities, any stocks or bonds that a company owns. Accounts receivable, which are the short-term obligations owed to the company by its clients, generally within the year, and so on. On the other hand, as an individual, your non-current assets would include your house, your car, and the value of a personal business or a rental property that you own, things like that. For a company that we're evaluating, we might see categories like property, plant, and equipment, or PP&E for short, which would include a company's buildings, land, machinery, all the way down to its computers. And then intangible assets, which can be extremely difficult to value, like patents, copyrights, trademarks. Those are worth something, potentially a lot, but it can be difficult to quantify. And in that same vein, there's a category called Goodwill, which is kind of a catch-all for some of those hard to value yet potentially extremely valuable assets, like brand name, solid customer base, good customer relations, good employee relations, and other proprietary technology. In general, companies invest assets to fuel their profit motive and accomplish their defined goals. But they also try to maintain liquidity so that they have flexibility in order to successfully navigate the many corporate and economic unpredictable variables that come their way. Now, liabilities are the opposite of assets. While you own an asset, you owe a liability. They are financial and legal obligations to pay a prescribed amount of money at some predefined point in the future. As you might expect, the liabilities are organized in a similar fashion as the assets with current and non-current. And the differentiating factor for these two is also the same. The portion of debt obligations that are due within a year are counted as current. For you as an individual, your current liabilities would include the portions of your debt payments that are due within the next 12 months. Or, if you're that colleague that I referenced earlier, that lunch tab that you're planning on paying me back soon. A company balance sheet's current liabilities, however, might include categories like payroll expenses, rent and utility payments, the portion of their long-term debt due within the next year, accounts payable, which represents unpaid supplier invoices, and so on. Your non-current liabilities would, of course, include the portions of any debt that you have, home, student, auto, that are due at least 1 year from the reporting date. On a company's balance sheet, under the non-current liability section, you might find long-term debt, long-term lease obligations, provisions for employee pensions, deferred tax liabilities, and so on. Liabilities can also, for some companies, include obligations to provide goods or services at some future date, which would obviously cost the company in question some money in the future. Thus, it's good for us to already be able to offset those funds. It gives us a more accurate picture of where the company actually currently stands. Finally, there's the owner's equity, also sometimes called the shareholders' equity. It's effectively just the difference between the assets and the liabilities. It's the amount that's left over and thus belongs to the company's owners after all liabilities have been accounted for, right? So as an individual, if you added up the value of everything you own, all your assets, and subtracted out all the claims on your money, your debts, your liabilities, the number you're left with is your net worth. For a company, that number is called the equity. You'll generally see two major categories here: common stock and retained earnings. The former represents money that has been contributed to the business in exchange for ownership, and the latter is earnings that have been generated and retained by the company. This information is like an X-ray for you. You can see the bones, the structure of a company at a specific point in time. Now, you can take that X-ray and compare it to the last imaging you had done from a few months ago to evaluate whether your bones look healthier or where you might be developing some weaknesses. With a company, when examining these snapshot images over time, you can see if they're headed in the right direction. Are their assets going up? Is the shareholder equity trending in the right direction? This can be helpful, but it will only provide you with limited insight. You'll also want to know where some of these variables stand relative to others, and then maybe evaluate how those ratios, those relative metrics, are improving or worsening over time. In this basics video, we'll go over 3 such metrics. These are the most commonly used, probably because of their relative bang for your buck. That is to say, they're super easy to calculate and understand, yet can provide you with a ton of quick, valuable information, such that you could draw your own lines in the sand as far as what is an acceptable investment to you, and then rule out thousands of stocks without taking hardly any time at all, simply because they don't meet your standard. The first is the current ratio. This one will help you assess whether or not your company in question has enough liquidity to cover its short-term obligations. The calculation to determine this is simple. The current ratio equals current assets divided by current liabilities. If the ratio here is 1, that would mean that you have just enough of those assets that could easily and quickly be turned into cash to cover all your obligations that will come due within the next 12 months. Most analysts prefer a current ratio of 1.5 to 2 or even higher. At the same time, every industry is going to be a little bit different, as is the case with all the ratios. So a valuable exercise in some instances might be to compare your company in question to others in the industry to see where it stands. Or if you're trying to identify the best stocks within a given industry, these ratios can provide some valuable comparable insights. But when comparing companies in different industries or sectors, you should really proceed with caution, as the respective industry standards may be different. So get to know the industry that you're working in first. Regardless, one of the most valuable quick insights you can glean from the current ratio is if a company might be in trouble. If the ratio is less than 1 or is rapidly declining over time, so when comparing to previous reporting dates, that could be a warning sign that the business might not be able to meet its short-term liquidity needs. An obvious problem. Next, we have the quick ratio. This ratio is very similar to the current ratio, but is even more conservative, as it removes a company's inventories from the calculation. Quick ratio equals current assets minus inventories divided by current liabilities. Inventory cannot always be converted easily into cash, at least not at its book value. If a company is inventory rich, the current ratio might not be telling you the full story. A quick ratio of 1 or higher is generally considered to be safe. But remember, it really depends on the industry in which the company you're assessing operates. And finally, we have the debt to equity ratio, calculated as total liabilities divided by shareholders' equity. This quick yet very insightful metric can show you the ratio of what is owed to what is owned. Right? Remember, the equity and the liabilities together equal the total assets. So this ratio is showing just how dependent upon debt the company in question really is to support its assets. In most industries, the lower this ratio, the better. The lower it is, the more in control of their debt situation a company would seem to be, but not too low. Most analysts, at least, want to see that a company is strategically leveraging debt in order to grow as much as possible. Although I personally wouldn't view a debt-free company in a negative light, it can be an indication that they are not growing as effectively as they possibly could. Again, set your own standard here. But more importantly, high numbers here should trigger alarm bells for potential investors. And if the debt to equity ratio can't be calculated, which happens a lot because the shareholders' equity is negative, that's concerning. That implies that the company's total liabilities are greater than their total assets. Not a great sign. Now, I'm sure it'll be more helpful for you to actually see it in action. So real quick, let's jump behind the computer to look at an actual balance sheet as we identify several of these different categories that we just went over, as well as a few others. Plus, we can run those real quick ratio calculations so that you can see how it's done. Let's go.
All right, so here we are on the ad-riddled Yahoo Finance page. We'll use that. It's as good as any free option that is out there. Let's look up Microsoft. Just a large recognizable company. Come down here to their financial information, and then it'll default to income statement. So let's adjust that to the balance sheet, and here we are. You'll see a similar breakdown to what we just talked about. You have the assets on top, and then the liabilities and stockholders' equity on bottom. Those equal each other. You can see that every single year they are the exact same. And you could switch to quarterly if you wanted to get a quarterly breakdown of each of those. But for our purposes here, we'll just look at the annual breakdown. All right, so let's start with the assets. We break it out. We have current and non-current assets. We can see that Microsoft's current assets as 181, and all of these numbers are in the thousands, so that's $181 billion in current assets. And if you look at the breakdown, you can see cash and cash equivalents equals 13 billion of that, and then other short-term investments equals 123 billion. You have net receivables, so the money that they're expecting to come in the near future is 32 billion within the next year. Inventory is pretty low, so we don't have one of those companies with an inventory problem here at 1.9 billion. And then other current assets, and you'll find these on sites like this. You'll find catch-all categories like this: other current assets, other non-current assets, same with liabilities. If you want a detailed breakdown of what those are, you'll have to look at their actual 10K or 10Q, where this information came from, to get that detailed breakdown. Sometimes that information is listed out on their balance sheet as they report it, and sometimes you'll have to dig into footnotes of their actual financial statements to get that information. All of that you should be doing before you purchase a stock, but you don't necessarily have to do it for your preliminary initial research when you're just trying to evaluate if a stock is one that you want to dive further into, which is what we're doing here, which is the point of just being able to quickly glance at a balance sheet and assess where a company stands. So that's your total current assets in the breakdown. Very similar categories to what we talked about earlier in the video. And then we can look at the non-current assets, which is 119 billion of their total assets. There you have the PP&E, the property, plant, and equipment, like we talked about. The value there is $53 billion. And they value all their land and their property and all their different equipment and all the breakdown there. I can't imagine how much is going into that at $96 billion. And then from an accounting perspective, they have been depreciating that property. Different items are going to depreciate in different ways, but as it's depreciating, then that comes out as a line item on the balance sheet. Right here you see it as subtracting out $43 billion, which is where they get the net property, plant, and equipment value. And then here is that difficult category that a lot of investors, they don't want to just take it at face value. They want to dig in and see what's being credited here. Are we talking about the brand Coca-Cola, which comes with, which is obviously extremely valuable, or are we just talking about the extra amount that a company paid for another company? And they wrote it off as Goodwill and reflect that value here. So 43 billion is pretty significant. When you look at their total assets here, 43 billion divided by their 301 billion in total assets. I mean, you got 14%. That 14% of their total current assets are reflected in their Goodwill. So that's just something good to be aware of. I'm not saying that number is necessarily incorrect, but it's a very difficult thing to value. One example here that comes to mind was Microsoft's acquisition of LinkedIn. For example, it was publicly traded at the time, and the price per share was $131, and then I believe they purchased it for right around $196 per share. And so after you map that out, that's a $26.2 billion purchase price. And with the $131 share price, where the market was currently valuing LinkedIn. That would have been a roughly $17.5 billion valuation on the company. So Microsoft ended up paying almost $9 billion more than what the public was valuing LinkedIn in order to purchase it. And a lot of times you'll just see companies write that difference off as goodwill. It's the name brand, it's extra value that we can't really account for here, and it ends up showing up in this area. So anyway, that's what this is. That's what the goodwill is. And then you have your intangible assets, which we talked about, the patents, copyrights, trademarks, things like that. Again, also difficult to value. And that's everything for the assets. As far as the liabilities go, again, we have the breakdown of current and non-current. Your current liabilities are your current debt, so the debt payments, debt obligations that are due within the next year, the accounts payable, so any suppliers that they will be paying off over the next 12 months, taxes payable, so the taxes that they're planning on paying that will be due within the next 12 months, deferred revenues. So these are revenues that they've already recognized, but they haven't performed the service yet or delivered the good yet. So that's still going to cost them in the future to make that happen. And so they're valuing that at about $36 billion. So that's your current liabilities. Then the non-current liabilities include the long-term debt. So they owe about $60 billion on top of those current obligations. They have deferred tax liabilities that they'll be paying after a year. Deferred revenues, again, same as under the current section, except that they won't be delivering for at least another 12 months. And then your other category to catch everything else. And then we have the shareholders equity, which, as we talked about, the two major categories here are the common stock. So there's about $80 billion worth of common stock that's been issued. And then you have the retained earnings. So they've earned this money at some point in the past, and they've just held on to it with the intention of investing back into the company whenever they see an opportunity, whether that's for an acquisition or some improvements or whatever it may be. So those are your overarching categories, like we talked about, the equation that's going into the balance sheet. You have the assets. When you add the current and non-current together, you have your total assets, which equals the liabilities, current plus non-current liabilities, plus the shareholders' equity. And both of those values end up at $301 billion for Microsoft. But now if you wanted to look at, this X-ray as the example that I gave earlier in the video, compared to how it was a year ago, it looks like the assets are improving. The shareholders' equity is improving. The liabilities from 2019 through 2020 actually went down. So, that's great. They were going up before, but not by near as much as the assets were. So the ratio was improving. So you can kind of see the different way that you can look at these different categories. You could look at their individual cash position to see if that's improving, or more importantly, if it's quickly reducing. And again, you can also look at it on a quarterly level to evaluate all of these different aspects as well. But now let's run through those three metrics real quick, just so that you can see what I was talking about. So when I said the current ratio, you have your current assets divided by your current liabilities. So we can just round to the nearest billion here and take 182 divided by the current liabilities here of 72. And we have a current ratio of 2.5, a little bit more than 2.5, which is fantastic. That would make most analysts comfortable, make most investors comfortable, to feel like they are in a great position to be able to take care of themselves, to take care of any short-term obligations that they have. So if something crazy does happen in the economy, they won't be pressed by their current liabilities. They have enough sitting around that they can handle themselves and handle all their debts and all their obligations for at least the next year. But it looks like quite a bit longer than that when you're looking at current ratio of 2.5. In fact, if we want to be even more conservative, like we talked about, and go to the quick ratio, then we want to take out inventory, which for Microsoft, we already talked about how small that is relative to their rest of their assets. But if we did that, that would drop this part of our equation to 180 in current assets minus inventory divided by the current liabilities of 72 billion, which equals exactly 2.5. So for a quick ratio, that's phenomenal. So they're in an incredible position to be liquid when they need to, take care of all the current obligations that they have, or all the immediate obligations, debt obligations that might come up. And then the final metric that we went over was the debt to equity ratio. So we can just look at their total liabilities and their total equity, right? So here we're talking about the liabilities of 183 billion, dividing that by the shareholders' equity of 118 billion, which leaves us with a debt to equity ratio of 1.5. So for every $1.50 of debt, there's $1 of ownership, of equity as a shareholder. So you can see here that Microsoft is using debt. They're leveraging their debt to grow, but they're keeping it within a reasonable range. So when you run this calculation for some companies, you'll see this number get up to 5, 10, 15, 20. Sometimes it's extremely high, and sometimes it's not calculable, as I said, because the shareholders' equity is actually negative to make this equation work, because the company has more liabilities than it does assets. And then one other thing that we talked about doing with this, and I'll just do it here with this last metric, is comparing to how they've been doing in the past. So when you look at their debt to equity ratio before, you had your debt last year of 184 billion divided by the equity of 102 billion, and it was 1.8. Remember, the higher the number, the worse. So they've been improving. The year before that, it was 176 billion divided by 82 billion, and it was 2.1. So they've been gradually getting better and better, and you can visually see that by these numbers and by how they're changing versus how the equity's changing. This gives you an idea of what you're looking for over time. You can do these year-to-year, quarter-to-quarter comparisons for any of these metrics, or for the numbers themselves, just to make sure the company's moving in the direction that you, as an investor, as a part owner in the company, would want it to be moving.
So there you go. That was a brief look inside corporate balance sheet. And I hope this quick dive has provided you with a better grasp of what the balance sheet can offer you as an individual investor. There really is no more important document in helping you understand whether a company is thriving or just barely surviving. Now, if you're interested in seeing me run through more companies' balance sheets, just like this, maybe a little bit more in depth, but with the same unbiased analytical perspective, let me know in the comments. And on your way down there, don't forget to hit that like button. Also, if you haven't already, subscribe, hit the notification bell so that you don't miss any of this value. And if you'd like more from me and my team, you should check out our new free private community at community.spicercapital.com. Whether I see you in there or not, I really appreciate you being here and wish you all the best.